As we think about the luxury space, these go for very high multiples. So LVMH really wants to put a ring on Tiffany's finger,
Right.
and there are a lot of great assets at Tiffany, which are highly coveted.
Oliver, so it's the analogy you draw to Bulgari, Versace, Harry Winston. I mean, Tiffany is not in that category per se. Now, they're kind of trying to get there, obviously. But do they, A, deserve the same kind of premium? And B, they might think they're worth more, but if they say no to this offer, then what?
Well, Tiffany is such an iconic luxury brand, one of the only United States luxury brand. And what's critical about Tiffany is about 25% of Tiffany is bridal. Another 25% is gifting, and those are key attributes for how global luxury is evolving. Also, second, Tiffany has great diamond supply, sourcing, polishing facilities. About 60% of their goods are sourced internally. That's very valuable too. And being in the hard luxury sector is extremely covetable. LVMH wants to compete hard against Cartier, Richemont, and this would bring LVMH's jewelry revenue from 9 to 17%. These are all very competitive factors, and hard luxury, which is a category Tiffany's in, is one of the most attractive categories for the long term. It's very un-Amazonable, and as we think about China and gifting, that's a huge long-term growth opportunity as well.
It's interesting, Oliver, and you make a good case for the 160 to 180 sort of valuation, but the markets don't seem to believe that at all. I mean, the stock is trading up to 128, which is not much more than the reported bid that's on the table. Why do you think that the market doesn't see 160 to 180 at this point?
I think it's a bit of wait and see in terms of this bid and this process being very new, and there's uncertainties. A deal may or may not happen. There may or may not be other bidders, and it's already up 30% from Friday. So the market's reacting. There remains more to be seen. I mean, we're out there with this view because I believe luxury assets are very valuable, and we do have an outperform rating on Tiffany because this franchise is very difficult to replicate. This is once in a lifetime in terms of this asset being available in the marketplace, and what we're seeing in this whole space is both fragmentation as well as consolidation, and major luxury players like LVMH, Richemont, Kering kind of evolve and really need to speak to new customers, and a digital age is ready as well. So there's many forces at play, but a lot's going to be happening, and the stock will be highly volatile over the next few weeks or months as well.
Oliver, you mentioned that this is a once-in-a-lifetime opportunity, but it's not really. I mean, Tiffany's been hanging out for a while now, you know? So who else might this be an attractive asset for if this is the moment to pounce, so to speak?
Yeah, it's a big moment because this hard luxury asset will really enable somebody to compete against Richemont and Cartier. All the luxury players being big players, it's important for them to have exposure to jewelry. As we think about Tiffany, Tiffany has a big watch opportunity. Less than 1% of total revenues is watches, and other product categories as well. And also, other players really like Tiffany's bridal business. It's a little bit tougher for players like Bulgari to be authoritative in diamonds and bridal's a great category as other countries really use diamonds as well. So these are coveted assets. I think there will be other strategically interested bidders. There could be financial buyers. But as we think about the math and the fundamentals around the discounted cash flow, a lot of the strategic bidders will have the most revenue synergies as well as cost synergies. Mathematically, and as we look at our income statement, the operating margins are lower at Tiffany. They could be higher.
You've tantalizingly mentioned the possibility of other buyers, strategic or financial. Who might they be?
Yeah, I think we look across the landscape in terms of like who are the large luxury players. They are Kering Group, which owns Gucci, as well as Richemont, which is Cartier and Van Cleef, and then you have LVMH, which owns Bulgari. Those are the major players, but the reality of the analysis is how much debt capacity and financial free cash flow these business models have. As we did our analysis this morning, Louis Vuitton generates $5 billion of free cash flow, and their leverage ratio is pretty modest at 0.8 times. So it's both EPS accretive, and they have the financial capacity to do it at LVMH. Those are very good places for LVMH to be, and they'll get strategic synergies. So the question is, how do you split up that valuation to shareholders, and what happens in this process over time? It'll be dramatic and interesting.
Oliver, real quickly before we go, if this moves forward, maybe even if it doesn't, but who do you think, is there someone now that this kind of triggers a, hey, these are the next names that might now be up for grabs to you in the retail space, or is this a unique situation?
Yeah, I really think like we're living in an age of brands, and we're having both fragmentation and consolidation. As we look to other players, it's who's unamazonable, who has a great heritage, and other brands in the marketplace. So in the handbag space, in the outerwear space, these are all categories with good growth characteristics, and we've seen some nice pockets of growth in beauty too, where brands matter, and Walmart's been doing M&A as well. So the emotions, the innovation, the cultural relevance, the digital intensity, and digitally native brands have been acquired too. So rethinking brands and the power of brands and how brands can extract pricing power, these are all themes we're pursuing in a lot of our work.